If you look at the headlines about the retail industry over the last decade, you would think that brick-and-mortar stores are extinct. We are told that e-commerce is eating the world and that physical shopping is a relic of the past. Yet, if you look at the stock chart of ROST stores over that same period, you see a completely different reality. While others were closing doors, ROST was quietly becoming one of the most consistent compounding machines in the market. Today, we are going to dive deep into the financial reports from 2020 through the end of 2024, and crucially, analyze the latest data from the third quarter of 2025. We will uncover how this low-tech, off-price retailer is not just surviving in a digital world, but is aggressively planning for a future of massive expansion. We are going to deconstruct their treasure hunt business model, their unique inventory strategy, and why their roadmap to 3,600 stores might make this the ultimate defensive growth play for the next decade. To understand where ROST is going, we first have to understand the engine that drives it. ROST Stores operates on a model that is deceptively simple but incredibly difficult to replicate. They are an off-price retailer. This means they buy name-brand apparel and home goods at a significant discount, usually from manufacturers who have overproduced or have canceled orders, and then sell them to you at 20 to 60% off department store prices. In the Q3 2025 presentation, and consistently throughout their annual reports, you will see references to their inventory levels. Unlike traditional retailers who need to sell everything this season, ROST buys heavily when prices are low, packs the merchandise away in their warehouses, and releases it months later when the season is right. This allows them to protect their margins in a way that typical retailers simply cannot. Let's look at the numbers, because they tell a story of resilience. The 2020 annual report shows a company battered by the pandemic with stores closed for weeks. But watch the recovery in the 2021, 2022, and 2023 reports. It was a V-shaped recovery. By the time we get to the third quarter of 2025, the company is sitting on a fortress balance sheet. They reported ending the quarter with $5.4 billion in total liquidity. This includes $4.1 billion in unrestricted cash. In a high interest rate environment where debt is expensive, having this level of cash is a massive competitive advantage. It allows them to fund their own growth without borrowing, and it allows them to return cash to shareholders through buybacks and dividends, which they have done consistently. Now, let's talk about the core of the growth thesis. Store expansion. This is the most exciting part of the data for a long-term investor. As of late 2025, ROST operates roughly 2,100 stores combined between their ROST Dress for Less and DDS discounts brands. However, their long-term guidance, reiterated in the Q3 2025 presentation, targets a potential of 3,600 stores. That is a runway of 1,500 new stores. They are opening about 90 to 100 stores a year. This isn't explosive, risky tech startup growth. This is methodical, predictable expansion. They are entering new geographies and densifying their presence in existing markets. The addition of DD's discounts, which targets a slightly younger, more urban demographic with even lower price points, gives them a dual-engine growth strategy that many competitors lack. We must also consider the macroeconomic environment because ROST is what we call a counter-cyclical stock. When the economy is booming, everyone shops everywhere. But when inflation hits or when the economy slows down, consumers trade down. They stop going to full-price department stores and start looking for value. The financial data from 2023 and 2024 reflects this shift. As inflation squeezed the average consumer, traffic to off-price retailers held up remarkably well. ROST is positioned as a beneficiary of economic uncertainty. Their average selling price is incredibly low, often under $15 per item. This makes them immune to the pullbacks seen in the luxury sector. They are selling necessities and affordable treats, not big-ticket discretionary items. However, no analysis is complete without looking at the risks. The annual reports from 2022 through 2024 highlight the pressure of freight costs and wage inflation. Running physical stores requires people, and moving millions of items requires trucks and ships. When oil prices spike or minimum wages rise, ROST's margins get squeezed. We saw this impact in the operational data. Yet, what is impressive is their ability to manage these costs. They have invested heavily in supply chain automation and efficiencies to offset these headwinds. Furthermore, they have no e-commerce operations. While some see this as a weakness, ROST sees it as a strength. E-commerce has low margins due to shipping and returns. By forcing the customer into the store, ROST maintains higher margins and encourages impulse buys, the treasure hunt effect, where you go in for socks and leave with a lamp and a jacket. So, what is the verdict for the future? The journey from 2020 to 2025 shows a company that is expertly managed and financially conservative. They have weathered a global pandemic and a period of historic inflation, emerging with a stronger balance sheet and a larger store footprint. The growth story here is not about reinventing the wheel. It is about doing a simple thing extraordinarily well over and over again. With a clear path to 3,600 stores, a strategic inventory advantage, and a consumer base that is increasingly hunting for value, ROST Stores represents a classic tortoise investment. It may not double overnight, but the combination of store growth, share buybacks, and dividends creates a compounding effect that is hard to ignore. As we look toward 2026 and beyond, ROST is proving that in the battle for the future of retail, price is still king and the physical store is far from dead.